I want to say a few words today about forecasts. Forecasting is essential in finance because finance deals with the future. Financial statements, which is a major source of information for finance, are dealing with the past, and so we have a small problem here. Finance deals with the future because investors are basing their pricing of securities and their investment in securities on their expected cash flows to those securities. Treasurers have to project cash flows in order to determine appropriate cash balances and in order to determine the best capital structure. Lenders use forecasts to analyze creditworthiness. In finance, we typically use what are called proforma accounting statements. Proforma literally means according to the standard form. It's Latin. Accountants prepare proformas that show accounting results as if an unusual event had not occurred. So let's say there's a merger or a spin-off of a part of a company. Then accountants typically want to show the investors what the company would have looked like had that event not occurred, and so the investors can compare like with like if they're comparing one year's earnings where the extraordinary event occurred to previous year's earnings where it didn't occur. This is basically asking the what if question. What if something occurred or didn't occur? The proforma forecasts that we make ask the what if question. What if certain assumptions are fulfilled? What does that do for the future of the company? Clearly, forecasts are wrong. But you can, if you're a good forecaster, specify confidence intervals around a forecast, thereby substituting error for chaos. Projected sales are the most important part in forecasting the financial statements. Typically one uses the growth in sales as the same growth number by which one inflates balance sheet items in working capital requirement and cost balances. One uses the capital budget to forecast fixed assets, and one uses known term financing of those capital assets in order to set long-term financing within the projections. Typically, when one is making forecasts, one wishes to have an output that is the short-term financing or indeed the total financing that is needed. Short-term financing or the total financing is typically a plug. Let's go to some forecasts here. These are forecasts for a fictitious company called Houcher Enterprises, and as you can see, we've got numbers from the past, 2012, 2013, 2014, for the income statement, the balance sheet, and the cash flow statement. The cash flow statement, of course, is a statement that is derived from the income statement and the balance sheet. So as you can see, I have developed the proformas. The top line is the revenue line. The revenue line is multiplied by the growth rate. Here I have a growth rate of 10%, but one common way of looking at the growth rate would be to say, well, what is the growth rate that we've seen over the last few years? And here we can calculate the growth rate, the compound growth rate, as the 2014 revenue divided by the 2012 revenue to the power 0.5, subtract 1. That gives us our historical growth rate. And then we can use that historical growth rate to generate a series of cost of goods sold and other expenses assumptions. So here we're inflating the cost of goods sold and other expenses by the same number. We're also inflating cash, working capital requirements of accounts receivable and inventory, and trade payables by exactly that same growth figure. You can see that I have input for the mortgage loan exactly the same number as the previous year, although it fluctuated in past years. I've said, well, we can use exactly the same fixed assets that we had in previous years. This is an assumption that needs to be checked with the company. And our plug is the bank line of credit. So the bank line of credit simply takes the total assets and subtracts from those total assets the liabilities that are not the bank line of credit. Note over here that I have interest. Interest is a function of the bank line of credit and the mortgage loan. But if I calculate the interest based on the bank line of credit and the mortgage loan, I will have circularity. Circularity is where the calculation requires the output of the calculation in order to be made. So here I get around that by calculating interest based on balances and assumed interest rates, and then I copy that number separately. I've chosen to highlight several outputs from our forecasting. Total financing, which is the sum of the bank line of credit and the mortgage loan. The line of credit, which assumes that the mortgage loan is totally available at last year's level. And the debt-equity ratio, which I took from the forecasted managerial balance sheet. I also included a line of credit coverage. This would be interesting to an external supplier of financing, here the line of credit, and banks typically take the amount of accounts receivable and they discount it by 0.75, the amount of inventories and discount it by 0.5, and compare that number with the outstanding line of credit. The collateral coverage, assuming that the bank had to liquidate the collateral in order to repay the loan if the loan was in default, was 1.09, just slightly more than the total amount of the loan. You can select various other outputs from the forecasts, including the cash flow pro forma forecasts, and highlight whatever part of the forecast you think is most appropriate to the analysis you wish to do. Forecasts are critically dependent on sales. We used sales to generate not only the sales figure, but the cost of goods sold and the working capital requirement numbers. Ideally, we would have capital budgeting forecasts that could allow us to estimate fixed assets investments. We also made assumptions with respect to the capital structure, that is to say that debt could be increased in order to meet financing needs. Our plug item, as it usually is in forecasting, was the short-term financing. Forecasts are only as good as their assumptions, garbage in, garbage out, but good forecasts based on well-analyzed assumptions can reduce unpleasant and avoidable surprises, thereby increasing financial efficiency.